Good morning and welcome to the Orlando Real Estate Buzz. We've had a couple of weeks off. You were there. I was here. We were all over the place. So your head's very big today, Joe.
Sorry, playing with my new camera.
So welcome. I'm Brendan with the Homes in Orlando team, joined as always by Joseph Dion of the Appley Home Loans. Got some good news yesterday. So we'll start right off with that. You won the bet. The Fed cut a half a point.
But you know what? It doesn't mean shit for mortgage rates. Like, it really doesn't. Not yet.
No.
Like, man, I need to watch my potty mouth. Like, it's not good here. Starting off bad, Brendan.
It's okay. Because the market really didn't do shit yesterday. Until late in the afternoon, it just kind of like, yeah, okay, we knew it. So what?
It's always interesting because it's like, the Fed rate, right? Like when we hear Fed rates and the drop and this, that, everybody assumes, okay, it's going to drop all rates across everything. Like everything's going to be impacted. But the Fed fund rate, which is your overnight rate of trade, right?
Short
like
term.
That's what the Feds allow banks. That's short term. So that means your things like credit cards are going to be affected. Your short-term installment loans are going to be affected. You're going to have like all these little things will get affected, or short-term loans or revolving debt. They're all going to see an improvement in the immediate. Mm-hmm. What's not directly impacted are your long-term debts, your long-term loans, like mortgages.
10-year T got worse. It didn't actually get better. It got worse.
So,
rates are up.
And that was actually, what was that?
Rates are up a little bit.
Rates are up. They're technically higher today than they were yesterday. They were higher yesterday than they were the day before. Like, in fact, Monday, we saw some improvement, but Tuesday, Wednesday, we saw worsening. Yeah. And I expected that because usually what happens in big news cycles like this, when you have big things like Fed fund rate and stuff, it's kind of like hey, here's the news, we got the news, and we're waiting, and then once the actual event happens, everybody kind of says on mortgages, they kind of pull back and go, okay, let's see what's going to happen in the markets before we start adjusting.
Yeah. I mean, here, if you look at the 10-year T over the past couple of days, basically since Monday, we have had a slow and steady increase upwards. But the Fed was cutting rates. The housing market's supposed to boom again. Everything's supposed to be wonderful.
Yeah.
But I don't think what a lot of people realize is, why does the Fed cut rates? What does that usually mean? Means the economy's not doing so well.
It's not doing as well as they thought.
Yeah.
They need to, right?
And you've got to loosen liquidity.
Yep.
The rates are lower, so liquidity should be easier to get, which should spur the economy. Correct? That's generally how you see it. And I don't know if you've been following Jamie Dimon at all, but he keeps warning that we're in for a recession. Yeah. Even with the rate cut.
Well, and this was interesting with the rate cut, right? I thought it was interesting because this was the first time I think I could be totally wrong, but I'm 99% positive I'm getting this statistic right. This is the first time ever that the Fed members weren't unanimous in what they wanted. We had 11 of the 12 members voted for a 50 BIP, but Michelle Bowman voted for a 25. And so that was just not a member, that was a governor member, right? So a little bit, I was kind of shocked, but I think I'm 90% positive that this was the first time that's ever happened that it wasn't a unanimous decision on the amount of cut or increase. So kind of interesting. You had one person that kind of pulled back a little bit and said, well, maybe I don't, but this is where my mind was kind of going into this. And this, I think realistically probably should have done 0 in my mind. Right.
When you look at the numbers that came out earlier in the week and last week, the Atlanta Fed changed the GDP to 3%. That's solid growth.
Yeah.
Very solid growth. And then, we look at things like today, like the jobless claims and
Jobless claims revised down.
revised down, and they're actually very strong. It was only 219,000. It was a decrease of 12,000. So, and then our long term has really kind of settled down, leveled off as well. So, those steady numbers seems to be, if things are working well, why do I need to cut the rates?
Well, you know what it kind of tells me? It tells me that all these reports are probably bullshit. Because they wouldn't be cutting if everything else was perfect. Now, there's the other side, which is the side I kind of leaned on, is we're going into the last quarter. Did Jerome Powell, did a lot of these members, did they want their legacy to be, we got inflation under control, but we drove America into a recession? Are they kicking the can?
They're still trying for that soft landing.
Are they kicking the can down the road to make it somebody else's problem? Because they know that maybe their time is almost up.
That's I can see that. And I don't care what anyone says. Jerome Powell is concerned about his legacy. He really is.
Oh, 100.
But what I'm looking at, I think my first comment to you yesterday when we were talking about where we think was going to go was, inflation is going to spike because we're going to get this liquidity back into the market. And if this liquidity gets back into the market, what's going to happen? It's going to force prices back up. So I know when you look at things debt-wise, Americans are tapped out still. And I think that's one reason why even with the interest rates dropping, we haven't seen that influx of buyers back into the market that we saw the year previously. When rates broke down below that 6.5%, we all of a sudden saw a big boost in number of buyers. People felt comfortable. I don't think people are feeling comfortable. And of course, you always have the election, which I've had the conversation with several of my clients in that, now until election, it's going to be slow. There's not going to be a lot of buyers. A lot of people are sitting on the sideline. I'm trying to convince my buyers that, hey, if you want to buy over the next month, let's go out and beat the heck out of these sellers because they're all panicking. They are all panicking because, one, the number of showings are down huge. The showtime statistics they're down close to 20%, since the previous year. That's a ton. And then it's interesting though, because you see how mentality works. And this is new home construction is actually seeing the biggest increase. And how do home builders look at everything? We're working with a smaller guy right now, and he's always projecting 8 to 10 months out. And his hopes are that, okay, we're gonna get these rate cuts. These rate cuts are going to transfer in to buyers, and I got to be ready with houses available for when the rate cuts really do take effect. And that's how he's looking at things. And I believe that's how the builders are looking at things too, because right now with the home builders, my gosh, I've never gotten so many flyers every day.
I saw someone, and I saw someone advertising 3.5 introductory rate on a builder.
Yeah.
Like that forward commit that they're doing. Wow.
Oh,
they're investing a lot of money to try to move that inventory.
Yeah, they're all down below 5%. And it's not just the 1 year, 2 year buy downs. They are buying these things down for 30 years. So you look at those forward commitments and you're just like, man, it's costing them an arm and a leg. I think it was Pulte who came out with some numbers, and it costs them about, what was it, $40,000 or $50,000 in incentives to sell a home.
Yeah. No, that's a lot.
That is a lot of money.
Craziness.
That's crazy.
That's absolute craziness.
So you understand why they've got the houses priced so high.
Yep.
But a lot of it, I think a lot of it though is it's a mental thing. Is
Mhm.
because most people think because they've been taught incorrectly that hey, the Fed cuts rate, mortgage rates are going to be great. And I think it's a
Yep.
mental thing, and I think it's you look at the housing uh, builder the builder feeling on the market. It went up
Yep.
1 point. I mean, not much. Went from 40 to 41, and it went up based on projected rate cuts.
Yep.
So again, it becomes mental on a lot of things. Whether or not people are feeling good or not, and not so much on the fundamentals. So I just I looked at it this morning because I was just curious. What's the forecast coming in to November's meeting now? And right now, the bet is we're going to get another 1/4 point cut.
Well, I believe, didn't they say, Jerome, like, wasn't there talk that they're expecting another 50 bips before the end of the year?
Look at this. 4.25 to 450. 35% right now feel
Like,
that we may get a 50 basis point, another 50 basis point cut, which would be great. Would be great for us. Hopefully, it pulls that 10-year yield down a little bit. But I think the hardest part for us is that when you look at, and these are the things that people aren't talking about, behind the numbers, is you look at our deficit number. Our deficit number grew twice. It's twice as big as it was last year, this time. So how do you fund the deficits? You have to create bonds, correct?
Yep.
So if you've got more bonds, less buyers, what do you have to do to the yield? Increase the yield. And that's where I don't think people understand the disconnect between the overnight rate and the bond market. That's where the bond market really, really gets its drive from is all this debt that the U.S. is producing. Do you see have you had a chance? We were talking about it a lot last year, and we haven't really talked about it much this year. But have you seen the reverse repo window?
I haven't. Haven't been keeping up the way I should be.
Yeah, it's almost out of money. I think it was down. Was it 281 billion left? Something like that. It was down quite a bit. It had steadied off for 2 or 3 months, so people kind of like quit talking about it. And then
it looks like it's sitting right around 300 billion right now.
300 billion.
305.
Yeah. So it's down quite a bit. That's not a lot of money left in that reverse repo. And when they release that money, what is that? That's liquidity into the system.
Yep.
Again.
Exactly.
So we've continued, even though they say they've quote tightened, we've continued to put liquidity into the system.
Yep. Yeah, I mean, well, if you talk about, we were talking what? And I know that they were talking about pulling it down, bring it back, and we talked a lot about this last year because it was sitting around 2 trillion.
Mm-hmm. Yeah. Yeah, when it started out,
2.1 trillion. And from 2021 up, realistically, it was very small, and in 2021 and earlier, there were brief pockets where it jumped up, but 2022, 2023 is where it kind of, since the Fed started pulling back on this, right, it's going down. That's what they want, right? But we still need it. I don't think we're in a position that we can get rid of it just yet.
Yeah. Yeah. And I don't know what they do. Do they create another window like this? Quite honestly, what they would do is they would go to the computer, like Jerome Powell said, oh, let's see, I need $2 trillion. Hold on. Okay. We got 2 trillion.
Got him.
Got it. Is that,
man,
is
I
that
really
what
like
we're
to do that. I don't need to do, can I just do it? Can I just get a 10 million line like that?
Is that what you need? Hold on, Joe. Which account do you want it in? Let me get wiring instructions. So I mean, I still call me a pessimist, but I still see trouble ahead in a lot of areas. The buyers are still on strike in the housing market, and I think, I mean, I thought it was 6.5. I mean, I think it may be now. We may have to get down to like 5.5 to really start to get to turn this market around.
Well, we're in this weird segment, right? Because you saw that, right?
Yeah, that's pretty cool.
That's gonna, but you know, we have this little bit of fun where I think it was 6.5 in the market, but values kind of continue to go up, and now we have a lot of like uncertainty. Okay, well, where's the direction? Where's this? And now people know rates might be going down. They're starting to go back down. So just like we saw the same phenomenon when rates were in the 3s, like when they went to the 4s, then the 3s, and then into the 2s. Like we dealt with so many buyers, like it was really aggressive, right? But there was those buyers that were like, oh, maybe it'll go to 1s.
Yeah.
And then they missed out entirely because they waited. I think we're at a point now where your pool is so small that, you know, when people do sit on the side and go, well, maybe if it drops down, because they're hearing this talk of, you know, and this is where like I'm very, very cautious on when I say where I think rates are going to go and so forth. And my challenge is there's a lot of people that work in industries that maybe shouldn't be saying where they think interest rates are going to go.
Yes.
Or maybe they just don't, like, maybe they do. Like, I have no problem when, and I see it both in loan officers and I see realtors. Like, I see it happen all the time where they don't understand basic economics. But they're sitting there saying rates are going to go into the 3s, or they're saying rates are going to go into the 4s. And they're putting all this media and advertising out because that's what you are. You're on social media site. You're on Facebook, Instagram. You're advertising something. And you have an audience that's now getting maybe incorrect information because you're not putting any disclaimers around this, right? You're just willy-nilly throwing an idea, but people are seeing your title thinking you're an expert, and now they're making decisions that impact their family. And that's the hard part. Like, we can always say, like, oh, well, do your own research. Well, sometimes people are feeling like, well, part of my research is looking at what the local expert is saying. You know, and I think that's the hard part is, you know, I'm going to take something that you share with me, Brendan, if you put, because I know the caliber and the amount of research you put together. I hope people feel the same way about myself, but I'm very hesitant. I'm like, hey, I think they might go here, but I feel like it's probably going to be here, and it could not even do that. It could go up. Right. Like we kind of pretense of like, here's where we think. But the reality is we don't know. Like, we're utilizing historic norms and data to kind of guesstimate where we think. Well, there's a lot of people that are like, Fed rate went down. Rates are going to be in the 4s. And I'm like,
oh my God, how many Instagram videos do you think are out there today by mortgage brokers and realtors? The Fed just cut the rates. Oh my God, it's a great time to buy.
Oh, yeah.
Are you kidding me? Are you kidding me? Did you watch the 10-year T? Because I did. Yeah. It went the opposite way.
The problem is a lot of those that are saying that either A, don't care about the consumer and they're just trying to get a deal in the pocket, or B, they don't even know what the 10-year T is. They don't even know what the bond market is. They're completely confused on anything that actually impacts them. That's a lot of boring stuff. If you're watching this right now, guys, I hope you haven't gotten lost in this. Just know that the federal fund rate, though it will have an impact at some point, it's not a direct correlation. You know, though when it goes down, typically rates will follow in a similar fashion. It's not a direct correlation.
Not a direct correlation. Never has been. Never will be. Never will be. But, you know, talking about that, you know, let's look at the market today. You know, as far as the Orlando market and what's been going on with the Orlando market, because it's still very stagnant, even with, you know, a slight decrease in interest rates, it's still a very stagnant market. I mean, the week before we had only 331 sales. That's it. This week we jumped up to 405, and our inventory is still increasing. We went up another 95 homes on the inventory. Then the condo market, condo market's the condo market, which is just stagnant as can be overall. We're barely breaking 100 on a weekly basis in sales for condos. And again, their inventory's up by 69 homes. And then we start looking into, the deeper numbers, which look at our months of inventory. We've jumped back up to almost 4.5 months worth of inventory.
Mm-hmm.
And then look at this, the original list to sales price. We're on average 92.5% off of the original list price. So there are price decreases. And I've started on a weekly basis putting out all the price decreases because we've got so many. And it's something that people should have knowledge of is, okay, who's cutting their price and why? And why are they doing it? Because the average days list to contract is 55 days.
Yep.
Remember what this was like a year ago? 21.
Yeah.
21. We have more than doubled the days on market in the past year. And again, look at our over $1 million homes. 87.5% of original list price. 92% of the final.
Mm-hmm.
I still laugh. I was watching, I think it was CNBC or something like that, and they were saying that there's a shortage of $1 million homes in the country. Come to Orlando. There's plenty. We have lots of them.
The problem is in Orlando, that's not the $1 million isn't getting what people want.
Yeah. You have 800 homes listed for $1 million or above right now in Orlando.
Yeah.
And you want a deal? Here you go. Take the original list price, multiply it times 87%, and you'll get a rough idea of what you should be paying for that house. And look at, really the whole year, look at our sales. Just over 425 average, 438 since May.
Woo.
No jump in the summer whatsoever. We had no jump in sales in the summer. This is an end of month, which you always get a little spike, end of month, little spike. But otherwise, the number of homes being sold in Orlando is averaged just over 400 homes. Think about that for the size of the community that we have.
Yeah.
We're what, 1 million plus now, right? In Orlando, roughly.
Yep.
And then look at our inventory. We are up nearly 40%
since January. Just a small tick up.
Yep. And what I think we may see is this jump even higher because mentally sellers are going to go, oh, the Fed just cut rates. I've been waiting to put my house on the market. The Fed cut rates. Rates will be better. Buyers will come back into the market. And I think we may see that over the next couple of weeks, the number of homes increase simply because people are going to look at the Fed cut that way.
Nice.
And then we get into oh, look at this. This is condos. Look at our condos.
Do we really want to?
8 months of inventory in condos right now. Talk about a buyer's market. And then look at original list to sales price. 93%. And almost 97%. Average days on market, 68. So these things are staying on the market. People are cutting their prices. People are going in and negotiating great deals.
I just love that there's 24 active condos on the market over $1 billion.
Yeah.
with no sales.
90 days on the market. Yeah, where are those? Gotta be downtown. Gotta be.
Yeah.
And then where's our, here we go. And look at our total actives here. We have 50% more condo inventory than we had in January.
Yeah.
And they keep coming and they keep coming. So, I mean, this is going to continue to go up. I think we're going to continue to see the prices drop. We've actually seen I think the average list price on the condos start to drop as well.
Yeah.
You know, they're not where they may have shot, say, for 250. They're shooting at 225. I mean, people are still going to, this is what a lot of people don't realize. They're still going to make money because most of these were bought at $100,000 to $150,000.
Yeah. I mean, gosh, if you bought a lot of these condos a decade ago, you bought them even less than that.
Yeah.
You know,
Yep.
I've talked to some agents or some borrowers where they're like, I can't believe I'm not. And I'm like, you paid $50,000 for your condo.
Yeah.
And you're selling it for $300,000. You've owned it for 9 years. Calm down.
Yeah.
Like,
You
where
had it
else do
rented
you
out.
get that return on investment?
Nature, it's just people's nature. You know, they always want to maximize their return. You know, you can't blame them. You can't blame them, but you know, shot of reality also doesn't hurt anybody whatsoever. So, but that's our market this week. Thanks for joining me, Joe. And thank you, everybody, for joining us. Please join us every week. Remember to like, subscribe, and join us every week here on the Orlando Real Estate Buzz. Take care and everyone have a wonderful weekend. Bye-bye.
Have a great one.